Imagine controlling $10 trillion, more money than the GDP of almost any country on Earth. That is the scale of BlackRock, the global investment colossus built by Larry Fink. Yet, despite presiding over this $10 trillion money machine, Fink himself isn't a household name. He's rarely recognized outside financial circles. Today, we're diving into Larry Fink's journey, from a young bond trader to the architect of BlackRock's rise as the world's largest asset manager. We will examine why BlackRock's massive scale shapes economies, ESG trends, and global finance. Fink's story begins on Wall Street in the 1970s. Fresh out of UCLA, he started his career in 1976 at investment bank First Boston, quickly making a name in the growing market for mortgage-backed securities. By his early 30s, Fink was leading First Boston's bond division, until a misstep taught him a hard lesson. In 1986, Fink's department lost about $100 million when one of his interest rate predictions went wrong. The setback was humbling and formative. This realization that risk management was as important as chasing returns inspired Fink to build a new kind of investment firm focused on rigorous risk control. In 1988, under the umbrella of private equity firm Blackstone, Fink and 7 partners founded BlackRock. Fink's vision was to create an asset manager that would invest clients' money and obsess over managing risk. Early on, BlackRock specialized in fixed income investments, applying cutting-edge analytical models to protect investors from the kind of surprise losses Fink had witnessed. This risk-centric approach, eventually embodied in BlackRock's proprietary Aladdin risk management system, set BlackRock apart. The firm started as a small bond manager, but Fink's ambitions were big. By 1994, BlackRock had parted ways with Blackstone to become independent, and in 1999 it went public on the New York Stock Exchange. Fink would remain at the helm throughout, steadily steering BlackRock towards greater heights. Fast forward to the mid-2000s. BlackRock was growing steadily, but the 2008 financial crisis would prove to be a springboard for its astronomical rise. In 2006, Fink had already made a bold move by acquiring Merrill Lynch's investment management unit, roughly doubling BlackRock's assets under management. But it was the 2008-2009 period that truly transformed BlackRock into a financial titan. During the depths of the crisis, the US government turned to BlackRock to help manage and unwind toxic assets like failed mortgage investments that were weighing down markets. BlackRock's trusted position as an advisor to the Federal Reserve and Treasury in 2008 not only generated fees, but also cemented its reputation as the go-to firm for solving financial emergencies. This close cooperation with government officials wasn't without controversy. Some questioned whether BlackRock's government contracts, often awarded without competitive bids due to urgency, created conflicts of interest given Fink's personal ties to policymakers. Nonetheless, the crisis elevated BlackRock's profile immensely. In 2009, BlackRock made a game-changing acquisition by purchasing Barclays Global Investors, including their funds for about $13.5 billion. This deal instantly crowned BlackRock as the world's largest money manager. From that point, BlackRock's growth was staggering. It went from managing around $1 trillion in the early 2000s to $5 trillion by 2016. By that time, the firm had 12,000 employees in 27 countries, reflecting truly global reach. BlackRock today manages about $10 trillion for its clients. That is a sum greater than the GDP of Japan or Germany, and only slightly behind the entire economy of China. BlackRock holds ownership stakes in just about every company in the S&P 500 stock index, thanks to the widespread use of its index funds. One of the biggest factors in BlackRock's success has been its dominance in exchange-traded funds, also called ETFs. These are essentially packages of assets, like bundles of stocks or bonds, that trade on exchanges like individual stocks. They often track popular market indexes, for example. An S&P 500 ETF holds all the stocks in that index and typically offer low fees and trading flexibility. In the 1990s and 2000s, ETFs were a niche product. Today, they are everywhere, powering the rise of passive investing. This is a simple way to invest broadly in the market instead of trying to pick winning stocks. BlackRock jumped on the ETF wave early, notably through the iShares brand acquired in 2009. BlackRock's iShares is now the world's largest ETF provider, offering over 400 ETFs that cover everything from US stocks to emerging markets to bonds. By 2024, BlackRock's ETFs alone managed about $2.7 to $4 trillion in assets, more than many entire investment firms. BlackRock scoops up roughly 1/3 of all new money invested in ETFs worldwide. The industry-wide shift to passive investing has been dramatic. Roughly 24% of the US stock market is now owned via passive index funds, up from just 7% a decade ago. Naturally, giants like BlackRock, along with Vanguard and State Street, the other asset managers forming the Big Three, manage the bulk of those index funds. In the late 2010s, Larry Fink made a highly public pivot towards ESG, advocating for environmental, social and governance principles in investing. Each year, Fink pens an open letter to the CEOs of companies BlackRock invests in, and these letters started to take on a strikingly activist tone. In 2018, Fink's letter urged company leaders to contribute to society and improve the environment, not just deliver profits. By 2019, he doubled down, telling CEOs they must step into a leadership vacuum and address social issues when governments fall short. This was a remarkable stance. The head of the world's largest investor was effectively saying capitalism should be more conscientious. Then came 2020's letter, titled A Fundamental Reshaping of Finance, in which Fink declared that climate change is driving a profound reallocation of capital. He announced that sustainability would be a core goal in BlackRock's investment approach, and that BlackRock would begin exiting certain investments that pose high sustainability risks. In other words, BlackRock was going to use its huge financial influence to push for climate awareness and a longer-term outlook in the companies it owned. BlackRock's massive scale means it wields extraordinary influence over global markets, and that has put it under increasing scrutiny from regulators and governments. BlackRock is part of the Big Three, funds that collectively own over 20% of all the stock in US public companies. In other countries, BlackRock is also a top shareholder. The Big Three hold at least 5% of the entire stock market in 16 major economies, including Germany, Japan, and the UK. Its investment choices can funnel billions of dollars toward or away from entire sectors, thus shaping economic trends. Through its advisory arm, BlackRock has even counseled central banks and governments. For example, advising the Federal Reserve in 2020 during the COVID-19 bond buying programs, blurring the line between Wall Street and policymaking. In the US, lawmakers have debated whether BlackRock and similar asset managers should be regulated as SIFIs, systematically important financial institutions, essentially too big to fail entities whose collapse could threaten the entire financial system. Senator Elizabeth Warren noted in a 2021 hearing that BlackRock holds a stake in just about every company in the S&P 500 and manages assets comparable to the world's third largest economy. Such concentration, she warned, could pose systematic risks if not properly supervised. In 2023, a US House committee launched an investigation into BlackRock for allegedly facilitating investments into Chinese companies that were on government blacklists. And in Europe, officials have mulled whether firms like BlackRock should face limits on owning too much of any one industry to prevent anti-competitive effects. Even state and local governments have weighed in. Some US states pulled pension funds from BlackRock in protest of its ESG stance, while others have partnered with BlackRock for infrastructure projects, underscoring the political tightrope the firm must walk. Regulators, politicians, and the public are asking tough questions. How should a $10 trillion bear market be kept in check? Can one firm prioritize both profits and the public good? Fink often finds himself defending BlackRock's actions on both fronts, insisting that purpose and profit are not at odds, and that BlackRock's influence is ultimately a force for positive change. BlackRock's sheer scale means it touches the lives of millions, from your retirement fund's performance to the policies of companies in your community. BlackRock wields power comparable to governments. As a result, Fink has become an influential figure, even if he operates behind the scenes. This shows how one visionary leader can redefine an industry. It also raises a pivotal question for the future. Can BlackRock use its unparalleled influence to not only generate wealth, but also guide the global economy towards stability, sustainability, and shared prosperity. The world will be watching in earnings reports, in climate incentives, and in regulatory chambers to see how Fink's $10 trillion engine drives forward.